Hello, my name is Mike Smith and I'm the president of T&K Futures and Options Incorporated. Today's video lesson is going to be about the grain markets, soybeans, corn, wheat, futures and options. Before we get started though, let's look at this risk disclosure statement down here. Futures and options investing carry significant risk of loss and is not suitable for some investors. Use only risk capital when investing in these types of markets, and past performance is not indicative of future results. Okay, well, over the 20 years or so that I've been a commodity trader, I hear a lot of the same questions over and over again. So I really want to cover those and just hopefully this will help you learn a little bit more. The first question that I get most often it has to do with confusion about the futures markets and margin. Well, margin is just a good faith deposit that you have to put up in order to go long or short of futures. It's different with every market, based on, well, a lot of factors, but the bottom line is the exchanges decide how much margin you're going to have to pay or put up in order to do that. Now they might raise it if it's very volatile times, to try to slow down the volatility and stifle speculation. So they might raise the margins. And if it's really slow, they might actually lower the margins to try to stimulate speculation and get more traders into the market so there can be more liquidity for that. So that's what they do. At the time of this video, I'm going to cover corn for now, but at the time of this video, corn margins are only $1,100. I've seen corn margins go up to around $5,000, so they can go up and down quite a bit. That's the initial margin that you would have to put up. I'm going to give you some hypothetical examples. So let's say that you open an account for $50,000 and you want to do this trade. You want to get long 1 December corn at $4. You think the price is going higher. Okay, so you do that trade on your online platform and that gets put aside from your available equity. So now you have $48,900 left to get more contracts, buy options, whatever it is that you're planning to do. So the contract specifications for corn, soybeans, and wheat are all the same. So that's why I kind of included them together here. They're 5,000 bushel contracts. Each 1 cent move is equal to $50. Here's the symbols. There's still pits for some of these futures markets. So there's the symbols for pit, CSW, corn, soybeans, wheat. The electronic version, ZC, ZS, ZW is the electronic versions. Those are the contract specs for the markets. The example I'm going to give you here on this futures trade is $4 corn, just for easy math, making these numbers up, just to show you your profit and loss type scenarios. So let's say that you get in here and you go long $4 corn, one futures contract, December corn, and it goes up to $4.20. Well, that's a 20-cent move. 20 times 50 is $1,000. It's a good day for you. You made yourself $1,000. Now, let's say conversely, you went long that and the market came down and it's at 380. Well, that's 20-cent move again. Bad day. You lost $1,000 on that one. These markets are very risky. You've heard probably horror stories about the commodity markets, futures in particular. They're probably true. I've seen huge margin calls for people trading their accounts. You have to be very, very careful. It's theoretically unlimited risk to the upside. And to the downside, markets can only go to zero, so your risk is finite to the downside. I've never heard of anyone losing infinity, but there is great risk. So you have to manage that risk. And that's the next question that I usually get is, how do you manage the risk when you're trading futures? And quite simply, a stop order is, I believe, in my opinion, the best way to try to manage your risk. Let's say, for instance, that you wanted to risk, on this particular trade, you wanted to risk $1,000. Okay? Well, you went long at $4. You would put a sell stop in at 380. And the way a sell stop works is the market's going against you, going against you, going against you, comes down, breaks that 380, sells through that 380, it automatically turns into a market order. Now, a market order is going to give you whatever the next available trade is. So that's why when I have risk here, I have an ish by it, risking 1,000-ish. And the reason is because the next available trade might be 381, might be 379, might be 380. So, you know, depending on how fast the market's trading, if it's very volatile, you know, that's called slippage. Sometimes slippage is worse than other times. Sometimes it's dead on. You put it in at 380, you're out at 380. Yeah, that confuses people. But that's the best way to manage your risk, in my opinion, is with some sort of sell stop. I wouldn't put a futures trade on without a sell stop. The next question I typically get is, what's a call option? Well, a call option is the right but not the obligation to buy the underlying futures for a specific time period at a specific price. Okay, let's just use this for instance. I made these up. So, buy 1 December 420 call at 15 cents. Okay, so say you wanted to do that. You wanted to buy a call option, betting on the market higher at 15 cents. Well, we know from our contract specs that 15 cents, that's 15 times 50, which is $750. Okay? So that's the premium you pay plus whatever your commission and fees are. When you purchase an option, your worst case scenario is you can lose whatever you paid for it, which is your premium plus whatever the commission and fees were. That's your extreme worst case scenario. You can get out of that option anytime before expiration, locking in profits, cutting losses. You don't have to hold it till the end. I'm going to give you some risk and profit scenarios, but let's cover the next question, which is, what's a put? A put option is like a call option, except it's a right to sell instead of buy. So if you're buying a put, you think prices are going down. So it's the right but not the obligation to sell a particular market for a particular time period at a particular price, which are these strike prices right here. Expiration for the grains is typically, it's going to be somewhere around the third Friday. So of the month before though. So if you bought this December 420 corn, it's probably going to expire November 21st, let's call it. So you have between when you buy it and then to do something with it. But let's go ahead and explain the profit and loss with options. It's a little different. It's not as cut and dried as this. There's something called a delta factor. And a delta factor is the percentage move that your option should catch based on the underlying futures. Okay. So let's say that you have this corn call. Market's at $4. The corn futures rallies 20 cents. And again, I made these numbers up. And let's say you had a 30% delta factor. Well, your option should catch roughly 30% of that move. I got another ish by 30% because as the market's moving, your delta factor is changing the whole time. You have to factor in, time decay, which is called theta, volatility premium, which is called vega. There's a lot of other factors involved in option prices, but 30-ish. So, if it moved up 20, good day, your option probably accrued in value by, roughly $300. If you were at $4 and the market came down 20 cents, well, in all likeliness, your option probably lost about $300. Might be more, might be less, but right around $300 is how that option should have changed. Now, the further you go out of the money, here's the money, it was right where the futures are. The further you go out, the cheaper those options are going to become. because they're less apt to make money. There's a lower probability of success. So the person on the other side, the option grantor that sold you that, can charge less as you go out, and it gets more expensive as you get in. Also, the more time that you have, the more valuable that option. So an option with 10 days left on it is probably going to be worth less than that same, an equivalent option with 30 days left on it, given everything else being the same, volatility and such. I know that's extremely, extremely confusing. So, if you need to, you can give me a call. You're probably watching this on the TK Futures website anyways, but if you're not, you go to tkfutures.com, find my contact information. Again, I'm Mike Smith. I'll help you with some of those questions. Also, I wrote a book that's available on Amazon. It's called The No Nonsense Guide to Buying and Selling Options. That might help you as well. I mean, if you're an option trader, it doesn't cover futures at all. But if you're an option trader, that might help you. I think that's about it, what I want to cover here. Yeah, I think it is. Okay, well, that's it. I hope you enjoyed it. Have a great